Hi, Jim Gore from Thor Wealth Management. We are overweight right now international emerging markets in our equity portfolios, and that is because they have underperformed for a very long time. And matter of fact, it's been the longest time period that they've underperformed. One of the biggest reasons for that has been a change in the currency. The dollar has been very, very strong, and you invest in other currencies, well, those currencies are getting less dollars back for what you invested. And I want to graphically show you that. There's what is known as the Big Mac Index, which shows how much it costs for a Big Mac in the United States compared to other parts of the world. So if you look at this chart, in 2008, you had Norway, a Big Mac cost 120% more than it did in the United States. Today, it's a -3, okay? Europe, you're paying 50% more for the same Big Mac. Today, you're getting it for 16% less. It's much cheaper to buy a Big Mac in Europe than it is in the United States. But even look at some emerging markets like Mexico. You got it for 12% cheaper. So you were buying it cheaper back in 2008. Now you're getting it for 61% cheaper. So this is the same asset. You're getting it for much cheaper. Well, those are percentages, but let's really talk about dollars. So if you look at the dollars, and let's assuming a Big Mac costs $5. In Norway, back in 2008, you were paying $11 for that Big Mac. And those people that traveled back in Europe in the 2008 and 2009 knew it was very expensive. We heard it from our clients that traveled abroad. And now it costs you $4.85. In Europe, in the euro, it was $7.50. Now it's $4.20. But then look at the emerging markets. The same assets in Mexico was $4.40. Now it's $1.95. So this is why people have lost a lot of money in international investments and emerging markets over the last 10, 11 years, is because their currencies have gone down in value versus the US dollars. We think that's going to reverse and it will have the opposite effect. So just think of it. You're buying assets right now, the same asset in the United States, a Big Mac. You're buying that asset for $5 here in the United States. You can buy it in Poland for $2.45. You can buy it in Europe for $4.20. And then Brazil, that everyone was all excited about in 2008, 2009, you're buying the same asset for $3.45. You're getting the assets much cheaper. We think there's much more opportunity in those investments. They have a higher yield than the United States stocks. And we think it is an opportunity that is going to reverse on the currencies. The US dollar will be going down as we print more and more money and we start seeing inflation. And so the opposite effect, you're going to start seeing things overseas get more expensive. And if you have money invested in euros, in pesos, those values are going to go up relative to the US dollars. And that's where you're going to make more money on the international emerging market investments. Take care, and we'll talk to you soon.